quickly go across to my colleague Poonam Sani, who joins in with a summary of the reactions she's sourced on the RBI credit policy review. Now, neutral has been the stance that they continue to maintain, Poonam, but it's really keeping a watch on inflation and the trends there, which would grab attention for some time.
True. In fact, Tanveer, if you look at the entire commentary from various brokerages as well as the top bankers, they do state that they were pretty much pleasantly surprised and some were even slightly puzzled with the entire tone of RBI policy. RBI's tone was relatively dovish than markets were expecting, and also it was relatively dovish than what most of the economists or bankers were also expecting. As a result, we did see the bond yield slipping to a 16-week low. INR has gained, falling slightly below the 65 to the US dollar mark. Bank Nifty and Nifty surge, and there is a likelihood that we do see some amount of still momentum in the bond markets as well as the equity, especially the PSU banks in trade today. CLSA, DBS, Macquarie, all three of them do state that it's likely that RBI stays on hold in terms of the policy rates in the entire 2018 itself. Morgan Stanley, however, does state there is a likelihood that RBI is likely to hike rates sometime in December. I do recall very well that BOFA had earlier stated for it or called for an August rate cut. I do not have that report right now, but that is something that we should even keep in mind. CLSA states that RBI's decision was in. However, there is nothing in the RBI outlook that would justify rates would be either raised or cut. Inflation is too high to allow rates to be cut, and India growth is too low for rates to be increased further. DBS also states that the April tone was less cautious. That's a notable shift from the February MPC minutes. Also, DBS states that RBI's tone and call prompts us to maintain that rates will remain steady in 2018, and they do not see CPI testing the higher band of 5 to 6% level in a sustained fashion. Macquarie also states that they do see the current year GDP growth to normalize somewhere around 7.2%. Do note that RBI is expecting the GDP growth for FY19 at 7.4%. Macquarie sees RBI to maintain the rates, and they're also stating that there's limited room for the bond yield to fall further from the current levels, and they do see bond yields to remain slightly in a range bound manner. Morgan Stanley states that they would focus on CPI forecast into FY19, but they are seeing RBI to hike rates in December, and they're not expecting significant overshoot of CPI relative to RBI's target. In fact, HDFC Bank economist as well as SBI chairman Rajneesh Kumar also has stated that they're pleasantly surprised with RBI's tone, and in fact HDFC Bank states that this entire policy, is this a transient bout of dovishness or whether it will endure, remains the key question. I guess most of the experts on street would agree to what Mr. Abhik Barua has to say, that will this entire dovishness endure or not. I guess we will have to wait and watch out for that. But as of now, good going for the bond markets as well as the equity markets.
Absolutely.